The tax-free personal allowance has been frozen for years on end and unless there's an unexpected U-turn from the government, is set to remain stuck at its current levels for at least another 4 years, until 2028. That means because of fiscal drag, more and more people are going to end up paying more and more tax on their earnings as wages increase to counter inflation and more people earn money that's liable to income tax. The personal allowance is the amount of money you can earn before you start paying tax, and it remains at £12,570, which is set to stay at until 2028 at the earliest. That means everything you earn above that is taxed at 20%, or 40% on earnings above £50,270 for a higher and 45% above £125,000 for an additional rate taxpayer. But there is one way you can increase your tax-free personal allowance, but you have to be married or in a civil partnership, and for the 2020-21 tax year, time is rapidly running out to make a backdated claim if you need to claim for that year. An individual is able to transfer 10% of their personal allowance to their spouse, provided that neither of them is a higher or additional rate taxpayer. This transferable amount of personal allowance is also known as the marriage allowance or marriage tax allowance. The transfer will be beneficial if the transferor has unused personal allowance, while the transferee is a basic rate taxpayer. The benefit is given as a reduction of the income tax liability of the transferee. The transfer of allowance is for the entire fixed amount available, £1,260 for the tax year 2024-25. Partial transfers are not allowed, even if this creates a tax liability for the transferor. The benefit to the transferee is a deduction in income tax liability of £252, £1,260 at 20%. However, this may be restricted, as necessary, if it would otherwise create a negative liability, as the recipient's tax liability cannot be reduced below zero. An election to transfer the fixed amount of personal allowance may be made up to 4 years after the end of the tax year, i.e. by the 5th of April 2029 for the tax year 2024-25. If the election is made within the tax year, it will continue to apply to subsequent years until withdrawn or the spouses are no longer eligible. Couples who are married or in a civil partnership can increase their tax-free take-home pay by £252 per year and backdate their claim for 4 years, too. This applies to up to 4 separate tax years if you backdate the claim. This means you could be looking at a tax rebate of up to £1,258. HMRC will then adjust your tax code to give you the money you're owed, which when added to the standard personal allowance for the year, £12,570, comes out at £13,830 tax-free instead of £12,570, handing you the £1,260 for the 4 years' worth of £252. In order to be eligible, one partner must pay no income tax, so earn under £12,570. For example, if one of the couple is no longer working, has lost their job or is taking a career break for childcare. The other must be a basic rate taxpayer earning between £12,570 and £50,270, once pension contributions are deducted. This process, called the marriage allowance, enables the lower earning partner to transfer £1,260 of their personal allowance to their partner and reduce their tax bill by £252 for each year claimed, 20% of £1,260. For 2024-25 a slight change was made that also allows someone earning between £11,130 and £12,570 to transfer their personal allowance, although earnings in between those amounts are still liable for tax. It does still work out to a saving, just not as great as those earning less than £11,130. But if you need to claim for 2020-21 tax year, you must do this before Sunday, as you can only backdate your claim for the current year and the past 4 financial years, so 2020-21 will be too far back as of April 6th. This tax relief can be understood through an example by 3 different scenarios. Pat and Christine have made an election to transfer the fixed amount of personal allowance from Pat to Christine. Pat has dividend income of £500 for the tax year 2024-25. Christine owns a small trading business. Scenario 1. Pat's earned income, £10,000. Christine's profits, £16,000. Pat's personal allowance will be reduced to £11,310, £12,570 minus £1,260. This fully covers his earned income and some of his dividend income, the balance of which is taxable at 0%. Christine will have taxable income of £3,430, £16,000 to £12,570. Tax on this at 20% is £686. However, the liability is reduced by £252, resulting in a final liability of £434. Scenario 2, Pat's earned income, £12,000. Christine's profits, £16,000. Without the election, Pat would not have a tax liability. However, with the election made, he will have taxable other income of £690, £12,000 to £11,310, resulting in a tax liability at 20% of £138. Dividend income remains taxable at 0%. As Christine will still benefit by £252, the election remains beneficial. Scenario 3, Pat's earned income, £8,000. Christine's profits, £12,900. Christine will have taxable income of £330, £12,900 to £12,570, with tax thereon at 20% of £66. The tax reduction from the election is limited to £66 out of the maximum £252, resulting in a tax liability of £0. Thanks for watching the video. Please subscribe my channel to know important tax matters and as well as other financial matters.